Hello, everybody. Welcome to another one of our FD seminar updates. This one, as you can see, is in relation to employment tax. By introduction, I'm Steve Ashworth. I am Head of Employer Solutions here at PKF Francis Clark, and I'm going to take you through a few things just to be thinking about at the moment. This has been one of the most challenging time, shall we say, for employers with the increases and everything which have been, well, are now all in place, to be honest. And sort of looking at your business and looking at where you can save costs and some of the inevitable outcomes of when you do try and save costs within your businesses is where I'm going to just give some of the focus today. Maybe make some suggestions to you over one or two things you can consider doing. The agenda for this session is we're going to have a look at some strategies to mitigate these employment cost increases that I've just touched on. Inevitably, I hate using the words, but it is coming around redundancies. So we're going to just focus, just make sure nobody's making any of the basic mistakes that can happen when you do look at redundancies. And also just getting you ready for what is going to come. By the time you watch this, you're probably well and truly in P11D season. And this might be the last year you actually have to do P11Ds. But like most things, there is a replacement on the horizon for it. Okay, let's make a start. We're going to, I mean, I suspect all of you are fully aware of what the cost increases have been, which came in from April. Those for national insurance contributions, minimum wage and living wage increasing. It also sort of has this issue around employees and directors who approach that £100,000 mark and what they can do. And a lot of the drivers at the moment are in relation to what I summarize these 4 R's. In fact, the fifth R is in there as well, of how do you recruit staff? How do you reward staff? Retain them, maybe retrain them if you're looking at sort of changing your workforce around. And that fifth R is the redundancy one, which, like I say, for some businesses, you don't want to be doing it, but it is inevitable. For some businesses anyway, not all businesses. This all comes out of the legislative changes, easy for me to say, from April 25 and the economy generally. The impact that the budget and everything's had and the planning and everything you need, as well as, and if you've watched any of our other updates so far, you probably have heard about the increased activity that HMRC are having in compliance. And employment tax is one of those areas where they do have a real focus on employers, be it the core employment tax areas or with national minimum wage and national living wage. So you need to be aware of that when you're thinking about what you might be doing within your business. What can you be doing to mitigate these increases? Well, it's not a bad idea to actually, let's get back to basics and have a look at your current payroll processes, all your processes, in fact, that revolve around sort of your employees, whether it's expenses, benefits. But maybe now is the time, before things change for next year, with all these increases, just take a step back and actually have a look at an in-depth audit of what you can do and how you can change things. You've got these thresholds and everything which have changed, and the wage changes as well, which is all affecting the costs. Wages, if you want to put them up, the increased costs, how do you pass these on? Any increase in wages then has a knock-on effect to the national insurance as well, and it's just it's a merry-go-round, really. You're just going round and round and round and trying to find some solutions. But do remember, when it comes to the national insurance increases, if you have under 21s working for you, or you have apprentices aged under 25 on a formal apprenticeship scheme, there is no employer's NI to actually pay. So that's really worth looking at. And we have seen quite a few times where employers have forgotten about this and they've been deducting national insurance from them. They do have special letters to use for national insurance contribution. So it's worth having a look at that when you're having a look at maybe doing this audit of your payroll, just to make sure that if you've got anyone in those categories, they're not actually paying national insurance. You've also got the use of a salary sacrifice. Some might call it salary exchange. Traditionally, for tax purposes, this is a sacrifice, but it could be an exchange. Sometimes semantic wise, employees exchanging something is better than sacrificing it. And that ultimately reduces the taxable pay. So this is particularly useful for any high earners out there. And it can bring significant savings for both employees and employers. Exchange works. So this is often in relation to sort of pension schemes, maybe cycle to work, even electric vehicles. But the big one where you can actually save some money is actually in relation to pensions. So this is just an example. It shows what is in place before salary exchange and what happens after salary exchange. And this is just how you actually deal with the pension. You take it out of gross salary, so it reduces down what is taxable and what is, in this case, particularly liable to national insurance. Okay, it becomes an employer's contribution, but as you can see, the savings there, if you work through the numbers, for employees of £120 and for employers of £207 per year. But okay, that might not be a massive amount per employee, but if you've got a large workforce and you don't offer salary exchange at the moment, every penny is counting within your business. So there is that real opportunity to make some significant increases. And there's a few other little tricks in that we could talk to you about as regards sort of implementing a salary exchange scheme. Um, some people still think it's not worth it, but I think we've had more and more clients, contacts coming to us and asking for information, and we've been making some significant savings for employers out there in this. What else have we actually got? Well, we got the employment allowance. That actually increased. So you get some national insurance savings here because it's increased to 10,500. But if you're a larger business, previously you couldn't claim the employment allowance because of this £100,000 restriction which was in place. That has gone now, so it's in place no more. So if you've not been claiming the employment allowance in the past, from this April, you may have been able to do. So when you do that review of your payroll, have a look and make sure that you've ticked the right box to now make that claim, because that's available for all businesses, regardless of size now, to actually set off. You might be looking at restructuring some of your roles, outsourcing perhaps some of your core functions. Do be careful. This is a real target areas of HMRC. If you start to pay people not on your payroll and you start looking at umbrella companies or labour agencies of any kind, it can have a significant impact on your business and it can attract HMRC to come out and have a look. So it's not to say they don't work. They do sometimes work, but they don't work for all businesses. So it's worth, again, maybe if you're looking at that and thinking of changing and outsourcing some of your actual roles, maybe just come and have a chat before you actually do it, just to see if there's any trip hazards actually in there. In addition as well, and this is one of my 5 R's, you've got reward. How are you going to reward your employees going forward if you can't use the traditional methods of extra pay? Well, you've got the tax-free exemptions in there. Make sure you're using them all. This ranges from car parking at the workplace, maybe having a staff canteen in place. Doesn't have to be a sit-down restaurant in your premises. It can just be offering food at lunchtime to your employees. Maybe some welfare schemes, and there's other tax exemptions as well. So again, might be worth just having a look at what might work for your business. Or perhaps you want to look at, long-term reward. How can I keep our key employees? How can I incentivize people to actually stay with our business going forward? And what are the opportunities? And this is where share schemes come in. You may have looked at it in the past, you may never have looked at it, but one of the most popular ones is the Enterprise Management Incentive, shortened to EMI. And I do have a few slides coming up. They're quite wordy, so just as a little bit of a summary, if this is a solution for you, um, if you have a trading company that fits within certain parameters, which are earmarked on the slides, which just follow in a second, and it's a good commercial solution for you, then EMI might be an affordable approach for you to consider. So you need to think about, what do I want to do for the business? Can I give some of the business away to the employees? Can I give them options? And options doesn't mean you're giving anything away until something triggers the actual purchase of those options at some time in the future. But it's a tax effective way of actually doing this. There are the qualifying conditions that I mentioned. So your starting point is, where is what is your company structure to have a look at the time of grant? Do you have gross assets in excess of 30 million, 250, less than 250 employees, full-time equivalents in there? The company must have a permanent UK establishment. And it also, on the right-hand side of the slide, it shows what some of the individual qualifying conditions are, as well as regards how much work must the participants in these schemes actually do. But again, this is an opportunity for your employees to grow with your business, and we are seeing growth out there. We're seeing an increase in people wanting to take up these EMI schemes, and this is why the reliefs are there. So, for a business that's worth 2 million at the moment, and it's going to grow and grow, and ultimately it's going to be sold at £5.5 million. You work down through those numbers, and you've got a potential gain for the employees of £82,000 in this example. So it's well worth having a look at and considering within your business going forward. And we've got people who you can talk to about how you implement it, and what the benefits can truly be for your business. Making effective tax rates for high earners. I touched on this right at the beginning, and this is where you get into this horrible sort of area of just over £100,000, when anyone earning at that level starts to lose their personal allowances when they go over this level. And really, that sensitivity to, the tax thresholds and maybe benefits in kind affecting it all needs to be looked at, because it's better, if you're only going to go over by a small amount, it's better to try and keep under the 100,000. Okay, so there's possibilities of looking at how remuneration, maybe moving it to a future year, or how your bonus structures actually work. We touched on earlier salary sacrifice to a pension. Maybe if you're just going over that 100,000, maybe you need to have a look at making a salary sacrifice into the pension scheme, or paying a bonus into a pension scheme, because it'll keep you under that sort of threshold. So that's something we can help with, and we can talk to you about in a little bit more detail if you've got employees, directors, higher earners who are around that sort of mark. We've got the redundancies. Like I said, it's not going to be an issue for every business, but we are seeing more and more businesses having to look at redundancies. And sometimes it might be a while since you've had to do this. The rules, you do need to be careful there. There is this magic £30,000, which is talked about all the time, about so long as you don't pay anything over 30,000, then you're probably going to have the tax-free amount that you can actually use and make a payment for. That is not always the case. If you do go over 30,000, it becomes taxable regardless. And you've also got employers only national insurance as well on anything over 30,000. So it can become costly because if you have a big payout, because you've got that employer's national insurance to pay on top of any redundancy payments that you actually make. You need to understand what the difference is between things like statutory redundancy pay, holiday pay, and payment in lieu of notice. And there are the taxable elements and the non-taxable elements within the termination payments. Again, if you're starting to go over the 30,000, there is a possibility to make better use of payments into the pension scheme, a commutation as we call it, into the pension scheme, which again can just make extra use of some of the thresholds and everything which are available. And depending on the timing, it's often good to look at, can I move this payment into the following year or make a redundancy payment, a compensation payment perhaps, over a number of years to make better use of that employee's tax allowances going forward. This was introduced a few years ago. I think it was at least 2018, the terms relevant termination award, RTA, and post-employment notice pay, colloquially known as PEMP, PEMP. And this is where an employee doesn't work their notice. But there are trip hazards with this, and you should always consider whether something is a post-employment notice pay. So are you making a payment for someone's notice that they haven't actually worked? And that in itself then becomes taxable. So be careful you don't, well, I suppose you need to be careful that you're not doing the calculation or not looking at it and at least thinking about it. So give it some consideration when you're making redundancies. Be very careful you don't get tripped up by payments of holiday pay, unpaid wages, bonus, which are probably all going to be liable to tax. So you need to be careful with that. And as well, you need to be making sure you're going through all the legal HR aspects. You probably do have a HR team or an employment lawyer on board if you're actually doing this. So, but they can do the words, we can do the numbers, and that's where it comes down to. So always better to take advice and not hear what some people use as a little bit of hearsay recommendations. Right, finally, I just want to talk to you about what is due to come in. It seems ages off, yeah, April 2026. But from April 2026, it will be in the main the end of the P11D. A couple of exceptions and everything around that. But the theory behind it is it's all benefits in kind, all those non-cash benefits, which you actually put down on P11Ds, company cars, medical benefits, all those kind of things. The revenue has decided to streamline the way it collects the tax on this. They're getting rid of P11Ds, and you will payroll either on a weekly or a monthly basis what you would normally be putting on to a P11D. So if somebody's got medical benefit, annual medical benefit, you used to stick that amount on the P11D. Now, well, from April 26, you will divide that out by 12 and put it through the payroll, or 52 if it's weekly paid, and put it through the payroll each week or each month. Okay. It's a lot more complicated than that when you actually come to some of the calculations you need to do to arrive at the cash equivalent. But it's going to be a big change. In fact, I've been telling people it's one of the biggest changes to pay as you earn for a long time. And you need to get yourself ready for it. HMRC believes this will be a simplifying of the process. The monthly reporting will mean that employees are paying their tax in real time effectively, rather than the historical system that P11Ds bring of always playing catch up and often ending up with an underpayment. What do you need to do to be implementing? Well, registration, if you might have already be doing this because you can pre-register and you can do it voluntarily. It's too late to do it now. You can't do it for the current year. You've just got to wait for April 26 now, when it will be mandatory. And we do believe that it could be an automatic process by HMRC. That's not been confirmed yet, but it could be. From April 26, you will just automatically be registered to payroll benefits in kind. Now is a period to plan. Okay. You need to consider, again, I mentioned right at the beginning, maybe looking at your payroll, doing a little audit, looking at all your expenses and benefits. Make sure everything is in place and is correct. Ensure all your stakeholders are prepared for this. That could be your systems and software setup, could be internal stakeholders, might be the external stakeholders, the people who provide you with the medical benefit information every year. Are they ready to actually send that information in? And most importantly is start now or in the next month or so to actually communicate this to your employees, because it's going to be a big difference for them. What was previously going through somebody's tax code after the P11D went in is now going to be, that tax code will be changed back to another, well, maybe back to full allowances. It won't have benefits and that going through it, but the employee needs to understand what is the difference to now this going through on a week by week, month by month basis. Okay. And as I did mention, there are a couple of exclusions to this. And that relates to beneficial loans and living accommodation, where there may still be a shortened P11D in place. So we've done seminars on this already, and it is really now is the time to start thinking about payrolling benefits. It might seem a long way off yet, but it's going to come round quickly. And that's it, really. Just as a little bit of a summary, let's look at being proactive to looking at the payroll strategy and where you can mitigate some of these cost increases. Make sure you understand if you do get to that position of redundancies is the only way forward, then think about what you're doing. Plan, 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 just to reduce any risks there. And now's the time just to get ready for this new benefits in kind system, the payrolling of it, which is going to streamline, ultimately will do, and reduce some of your burdens at the moment. Thank you for listening. If you do have any questions, please do come back to me. Hopefully, it's been a good insight there to what is happening in the world of employment tax. Thank you very much, and goodbye.